I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Superior, Colorado. Welcome to the show, Rick.
Well, thanks for inviting me on, Jim.
The U.S. Fed has hinted that it may raise rates this year, maybe up to 3 times, and that's really causing a lot of turmoil on the markets right now. Can you explain perhaps how that's impacted the price of gold?
Well, all the trends, the momentum players are having a feast today. You know, all the trends that have been in place for some while, stocks higher, gold and T-bonds lower, it looks like a capitulation to me. For the momentum, but just the same, you know, if the Fed was sweating the market's reaction to a rate hike, they've got quite a cushion here with the broad U.S. averages trading close to all-time highs.
I noticed that the Dow really jumped today because of this fear. Why would that be?
Well, the markets have been they've been led around the nose by crude oil, and I think that has to do with the ebb and flow of fears of deflation. So, of course, when crude rises, we've got all the banks ostensibly in better condition. They lent very heavily into the energy boom that never came after the 2007, 2008, after we began to emerge from the still out there Great Recession. So there's a little bit of breathing room here, and I still think we're in a broad topping pattern, but just don't get in its way.
Why would gold be in a position right now if there are higher interest rates in the U.S.?
Well, higher interest rates are going to attract money away from something that pays no interest at all. And, of course, gold is one of the least interest-bearing assets you can own. It's very much a speculative play in that sense. So higher interest rates obviously compete for money because they're perceived to be safe investments.
Now, of course, we've had a lot of prognosticators telling us that the equity markets are due for a major correction, perhaps losing as much as 50 to 70%. Wouldn't gold be a good hedge against that, or is that a matter of waiting to see if that actually happens?
I believe that. We had an enormous rally in gold, very steep rally from January into February, and the worst that the bears can throw at it right now is happening as I speak. So I think gold has really been correcting this very steep move that we had to begin the year, and I like it. On the mining side, I guess the deflationary piece of the argument says that the mining companies will have lower operating costs, and I think that's good for the gold mining shares in particular. They've held up relatively well in comparison to physical gold.
Gold miners, especially the juniors who've had a really rough 5 years, are they still good bargains?
They are if you think that they can survive. That was basically the way a lot of these miners were being priced maybe a year ago. Do they have enough cash to see them through the worst of times? And I think just the flurry of buying that we've had this year has put them in better shape. They look like a somewhat better investment with physical gold off its lows. So, and there's enormous leverage in those stocks, but of course when you get this rally as we've had this year, they do tend to get a little bit ahead of themselves.
Crude oil keeps tickling the $50 a barrel mark. Do you think it'll top 50?
I've been using a 51.49 target basis the July NYMEX contract, and I'm really a long-term crude oil bear, but I've been with the rally as it's unfolded simply because it was there on the charts to see. But the oddity about this dead cat bounce in crude, or the thing that makes it least believable, is that it's being driven by supply side story. And by that I mean in the past when we had bullish forecasts for oil and a run up in the oil patch, in the energy patch, the story was, well, it came from increasing demand. You know, China, the biggest buyer of energy at the margin, was driving prices higher, and you had, of course, a little boom in India that was creating additional demand for crude. So the traditional bullish story on oil is that the world is synchronously in some sort of recovery, or things are booming. But this time around, with all the desperate hopes that crude prices can somehow go higher because the banks have loaned so heavily into the energy sector, that they, that's a capital T, are trying to drive the story with this idea that curtailed supplies can push prices up. And, you know, a couple examples, you know, in Nigeria has cut output, and of course one other major producer, Venezuela, on any given day is a threat to shut down the oil fields. But my gut feeling is that you can't, using that story that supplies are diminishing, it's not enough to keep oil going higher. You know, you can get a period of buoyancy and this dead cat bounce, but it's just not a good story to sustain a further move of crude into the 60s. So I see low 50s as a place where oil is going to top, and beyond that, maybe a very long, meaning 3, 4, 5 years, a trading range between low 50s and perhaps 30.
And of course, the forest fires in and around Fort McMurray cut Canadian oil sand production by about 900,000 barrels a day, a third of Canada's production. However, they're about to reamp the production. The oil sands facilities that produce oil were not hit by the fires, nearly were, but of course all the people who ran them had to leave. But they're all expected to start trickling in starting June 1st, and the oil sand companies say the power lines that were downed are now back up. They've pressurized their natural gas pipelines so that they can run some of their equipment. So this temporary break in the Canadian oil supply, that's going to be back online very shortly. And in fact, would that affect world prices at all?
Yeah, the fire in Canada was certainly one of the things that was driving that supply side argument that the curtailed supplies can push things higher. But again, I would argue push prices higher, but only so far, and measured against the incipient global recession that may be coming because of the slowdown in China and Europe's perennial economic bust. Those factors are too much to overcome merely by, let's say, a temporary curtailment of supply.
We'll have more with Rick Ackerman right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Rick Ackerman. Rick, how much of a factor is the proposed exit of Britain from the European community expected to have on overall world economics?
I think that to the extent that it's talked and written about, it's greatly exaggerated. I guess the powers that be see political gain and leverage in saying that the world will end if Britain pulls out. Certainly, it would have its impact, I think, mainly psychological. The idea being that if Britain drops out, can 3 or 4 other countries be far behind? But they may be way behind. Britain has sort of gone it alone and done well because we've had the growth in London as a financial growth of a financial center there. So Britain is still very much a part of that economy, and I guess more than other Eurozone countries that could afford to remain independent. But I don't think ultimately Britain's withdrawal, it's leaving the Eurozone is going to have much of an impact.
Well, I mean, Britain kept its own currency. It kept the pound. So did Denmark. And Denmark has something like more than $1 million set aside for each citizen for their long-term pensions. So perhaps being independent and having your own currency was a good move on their part. Because apart from Britain and Germany, nobody else in Europe seems to be doing that well.
Well, I think the effect of it is something that is to be assessed on a country-by-country basis. And it's not so much... you take Switzerland, for instance. Switzerland has always been independent of everybody else's money, of other financial institutions, and they've had a problem, really, because, historically the Swiss have favored honest money, and I think that they stayed out of the Eurozone in order to maintain that reputation, but it's worked to their disadvantage. They've got there's such a skew toward precision manufacturing in the Swiss economy that a strong Swissy was going to kill their economy. So the Swiss have worked harder even than the Japanese to hold down the value of their currency. The reasons were different. The Japanese were sort of defending against the yen carry trade that made the yen a very popular vehicle, but the Swiss were essentially trying to impugn their own reputation just to hold the currency down.
Well, I was going to say, too, you can only sell so many Rolex watches. Once a millionaire has one, why do they need to buy another one?
Well, if you open any high-end magazine, you'll see that Swiss watches are very much it's going great guns. Prosperity has made very high-end watches, $20,000 and up, a booming industry for a relatively small number of players. But beyond that, the Swiss have continued to excel in the production of precision machinery, and they've taken full advantage of the computerization of the machine fabrication. So the Swiss are very much in the game, but they do have that currency problem.
Well, one thing Switzerland hasn't seen is a huge spike in real estate prices because they have very strong limits on who can possess real estate in Switzerland. Basically, you have to be a citizen and have lived there for a number of years before you can buy.
Yeah, that's true. And unlike other countries that take all the riffraff with just a couple $1 million liquid, Switzerland has some very high barriers. You have to be kind of Hollywood rich to buy a vacation home in Lugano or something. So it's definitely kept out it's restrained the kind of forces that you see in Vancouver, for one, that have pushed real estate into the ionosphere.
Right. Ross Kay, a real estate consultant, one of the few people in the world who actually is in that business, we just did a show with him, and Ross says there's $10.5 billion of money in the Vancouver real estate market that shouldn't be there, because he said normally real estate is generated by first-time home buyers because the people they're buying from are moving up in their next stage, maybe moving from a condo to a small house. But he said in Greater Vancouver and Toronto, that's not what's driving real estate. He said it's the sale of mansions the luxury and ultra luxury department where prices start at $12 million, and these people don't mind paying an extra $5 million on top of that. They're just desperate to get their money out of China.
Yeah, but I seem to recall, though, just a few days ago, a story that Canada, Vancouver, belatedly was taking steps to very much restrict that torrent of money that's pouring into real estate. I don't know exactly what the measures were, but they were prohibitive as far as how much you could put into real estate.
Well, what they did was ban the practice of shadow flipping, where someone offers to sell their house, say, for $5 million, but they have an assignment clause. So the real estate agent would give the owner $5 million and then a few days later flip it for $7 or $8 million. And of course, the original homeowner is out that extra $3 million. So the government has banned that practice. Also, they said corporations can no longer buy residential homes. It has to be an individual buyer. But we just had a mansion, or actually it's a compound, a complex, sell for $31 million, and the listed buyer is a, quote, student. So I don't know if these new regulations are going to make any difference at all. As you know, humans are terrifically creative when it comes to getting around financial regulations. I mean, how else did they get all this money out of China when you're only supposed to be able to take out $50,000 a year?
Well, it'll be interesting when the speculative bubble implodes in China. Certainly that's going to cut way back on, it's going to, I guess, initially push even more money into Canada and the West Coast. But ultimately, I think the result will be deflationary.
Well, Hong Kong itself, where they had booming real estate, sales are down 13%, I should say, are down 25%. Prices are down 13% since last September. So the shine is off the Hong Kong market already.
Uh-huh.
Mr. Trump, now that the latest polls are showing that Hillary and Donald are virtually tied in the polls, he wants a trade war with China. I've heard it could cost up to 8 million jobs in the U.S. if he does that. And he said he doesn't care. Is that the guy you want as president?
I think he will care eventually. He's come out against pretty much anything that has to do with free trade, and the economic arguments against him are not only persuasive, they become so visible within a short amount of time that I think Trump will retrace his steps on that promise.
Well, plus, if he's anti-free trade, what about Canada and the U.S., the world's biggest trading partners by far?
Well, we do have enough historical examples of protectionist pressures. Certainly from the 30s, a lot of economic historians blame the Depression on the Smoot-Hawley tariff. We don't have anything quite like that. In fact, at the diplomatic and policy level, free trade agreements have been popular, or let's say they've been pushed by Democrat and Republican presidents alike. So we've had a relatively strong free trade climate, but you can see the resistance in Trump's popularity.
Do people think about economics when they go to vote?
They think locally, which is a little bit despairing. The idea is what can possibly happen at the national level that's going to impact my household. And there we're moving so strongly in a populist direction, but it's so very wrong. The idea of $15 minimum wage coming on top of a retail environment where the big box stores, a lot of retailers are dying off, and I don't think it seems so common sense to believe that the higher wages are, the more employers are going to figure out ways to do with fewer employees. So it's a real killer, and even when you think it through, like people who've been working their way up the ladder from minimum wage at $8 an hour and then 9 and 10 and 11, well, all the new hires are going to come on at 15 at some point, and at which point, the guys who started lower on the ladder will, after 15 years will have worked their way up to what the new pay scale is. So there's a fairness issue there that it has to play out over the next few years. But I can't think of a more misguided idea than the $15 minimum wage.
Well, now we have major fast food outlets, McDonald's, Wendy's, are now having self-order kiosks, so they don't need as many workers. The taxi industry is looking forward to robot cars. Tokyo says by the time the 2020 Olympics roll around, the taxis in Tokyo will be robots. So that's going to see a huge displacement of these so-called minimum wage jobs.
Yeah, and it's all over. We check into the airport now with at kiosks, do most of the work ourselves, and we check out of the grocery store, using a scanner rather than a grocery clerk. And you can see the human factor, the human worker being displaced at a much faster rate than anybody might have imagined just 5 years ago.
Now, have they thought about what's going to happen to those displaced people?
Well, if the economy were generating lots of great jobs, that would be a good thing. We get people to work and start lower on the ladder. They can work their way up to good jobs, but I would say that right now, just in the U.S., where you see so many college graduates coming out, coming into a job environment where there's nothing that really meshes with their training, with their background, and there it requires a leap of the imagination to think that something is going to come along that creates lots of new jobs. The most obvious prospect would seem to be in the energy sector, but based on things that are just pipe dreams at this point, like cold fusion or solar with infinite battery storage. But so we really can't see what the next big thing will be, and the big thing now, it's questionable as to whether it's really creating wealth. We've got a digital economy. We're all doing each other's nails, so to speak, and shining each other's shoes. But you see that it's not really creating real prosperity because real wages have stagnated, and the debt load on all individuals, all households continues to increase. So we're sort of enjoying a higher standard of living, but it's coming mainly through borrowing.
And what happens when finally you've maxed out your credit card and they won't give you a new mortgage?
Well, I think you'd have to be in prison, really, to not qualify for a higher credit limit, and the human right of home ownership. The banks are, if anything, they're expanding their credit card lending because it's where the margins are the highest. Any market they go into, any place you put your money right now, getting more than 3% is difficult. But the credit card rates on revolving cards are scale up to 20% or so, and even with very high default and delinquency rates, it still winds up being a better investment for some of these the money stores than anything else they could do with their money.
Now, I've heard a big trap waiting for the banks are these 8 and 9 year car loans, because after about 4 years, that car isn't worth much anymore.
Yeah, we're going to have an enormous overhang of cars. We're coming off an 18 million vehicle year, I think, in the U.S., and if that's not the peak of the boom, it's certainly very close to it. And so many cars, I think 30% of them are leased right now, and the lease is essentially a way for people to buy more car than they could otherwise afford. So it's over time you could predict that people will be keeping their cars for longer, and that that we've definitely sown the seeds of a bust in the auto business.
Yeah, I can just imagine neighborhoods with scattered abandoned vehicles because, like I said, it's cheaper for the person to walk away and just leave it there.
Well, my son is in the fix-it-up business. He's been flipping Supras. That was a high-performance Toyota from the 1990s, but he's also done some collision work, and that seems like a good business because the insurers are still there, and they're still paying to have cars fixed, and cars are always breaking. So the used car and fixer-upper side of it, I think, will do quite well, but we've got a lot of cars to depreciate that have come onto the market through leases.
And one growing job market for sure, if robots come along, are going to be the robot repairmen.
That's true to an extent. I had a four-banger BMW in the 60s, and it was easy to work on. But these days, everything works off some black box. The car's emission system is all computerized, and most of the diagnostics are computerized, and you can't even open a shop anymore unless you not only have very expensive diagnostic equipment, but you have to keep it up to date as well. So anyway, it's good business to be fixing cars.
Rick, thank you very much for chatting with us.
Well, thanks for having me on, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He was speaking to us from Superior, Colorado. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions or comments for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.